Today we are talking about trading plans and how to use them to find the best trades. So in this trading plan tutorial, I will show you a step-by-step planning process that you can use on your own trading. I will show you how to find trades in a structured way and how to layer signals so that we can improve our trading quality. So as always, we are starting on a higher time frame, and here you can see what time frame we are always on. So this is the daily time frame. And here the first step is to wait for the market to show us this reversal candlestick pattern. It consists of 3 candlesticks, and this is by far one of my most favorite patterns that I have come to learn and understand and study over now almost 15 years of being a trader. And what you need for this is a strong bearish candle, then usually it is followed by a doji, an inside candle, and then a third candle is a strong candle into the opposite direction. So we can really nicely see the gradual shift of the market momentum. We're coming with a strong push downwards, so a lot of selling pressure, then the selling pressure is vanishing, and then a lot of bullish pressure is entering the market. And this pattern sets the tone for what we're going to do now, because now we're going to look for buying opportunities and we want to find trades that go long away from this pattern. However, just because this pattern emerges, it doesn't mean that we automatically should go long. We need to find other informations, other confluence factors, and we will go to a lower time frame in a moment where we actually time the trade and where we get into the trade. But this is the first step. On a higher time frame, we wait for this pattern to emerge, and then we see what else do we have. We zoom a little bit out and we can see here's a very big support and resistance level. It has been resistance twice. It is also a very big round number, 0.68. So it's a key level that adds confluence. Also, when we draw our Fibonacci from point A to point B here, so from the starting point of the breakout move to the top of the move, then we'll see our 23.6 Fibonacci retracement level lines up perfectly. That is also a good confluence. Next, we add our Bollinger Bands to the daily time frame, and we can see how first the market jumped outside of the Bollinger Bands and then the strong bullish candle brought us back in. So this is a Bollinger Band rejection. It's a very strong signal, and especially if it occurs in the right context, it's a very meaningful signal. So we have quite a few things that are on our side, and this makes this candle pattern that we saw in the beginning even more important. If we don't have location structure, if we don't have the round number, we don't have a fib level, we don't have the Bollinger Bands, then it is not recommended to trade it. But if we can stack and find additional information and those tools to help us understand that this is a higher probability trading scenario, we can go to a lower time frame. And now we are on the 4 hour, as you can see here. And here we are first creating trading plans, and then we also going to time our trade, get into the trade, set targets, stops, and all of the good stuff. So what we have here is, first we can identify it as a big round number, 0.69, always a very important number, also in trading. And we can see previous support and support also here on the flip, and it seems to be respected here once again. So we definitely want to make sure that we get above this level first before we go long. We also want to make sure that we don't go long as we are below the weekly pivot point. So here you can see this is the weekly central pivot point. It lines up perfectly with the 69 round number, and we want to make sure that we don't go long unless we have broken this. So a trading plan could look like a break and a retest pattern. We want to get above this level and then retest this area from above, and then we look for long opportunities. So now the first part is completed. We broke above this level and we are trading above it. So that's good. We are shifting to a little bit more of a bullish bias. Once we saw the candlestick pattern, the location confluence, the round number, the fib level, the Bollinger Band, we already had more of a bullish bias. However, we need to go also on the lower time frame to confirm the idea and to further plan it. So we are now looking even more bullish on the lower time frame. Now we are looking at a potential retest structure. So what we can see is that the price made it above this area here, which is also quite an important level. And now you can see we are building a head and shoulders pattern. Normally, what you do with the head and shoulders pattern is that you trade a breakout to the downside. However, if this pattern emerges and if it doesn't get triggered and the market actually moves higher, this then becomes a continuation pattern. So that's quite an interesting concept here that we are looking at. If you see a pattern emerge but it doesn't get triggered and it actually fails and the market trades in the opposite side, that could be a pattern in and of itself. We can also add a 100 period moving average to this, and you can see it lines up perfectly. So we really want to make sure that we get above this structure. We also want to get above the moving average before we get into a long. Which happens now. You can see how violently the market break out of the structure. So a lot of pressure has been accumulating in here. A lot of people had been waiting. There was a lot of compression within this pattern. And then once we really fulfill the last criteria, we are above the pivot, we are above 69, we are above the pattern, we are above the moving average, we broke out of the continuation, then we can really see how much pressure was released. And this is our final piece to the puzzle. Of course, not always will you have such a big breakout, and those big breakouts sometimes force you to use very wide stops. So not always will you be able to actually trade those huge breakouts. However, trading never follows our textbook patterns, so we have to deal with different situations and also imperfect situations, and that's what we're looking at. However, this could have been your potential entry signal based on everything that we have covered previously that led us to the bullish bias and now to the final piece. And you can see afterwards, this is what happens after the breakout. The market pulled back a little bit, and then the uptrend really got on its way after we had everything on our side. So really nice trade study, I think, higher to lower time frame. We look for the trade idea on the higher time frame and the bias, and then we drop to the lower time frame, create the trading plans, and wait for everything to fall into place before we can execute it. And this is a good idea of how to structure your trading in general. Look for different confluence factors, look for different signals. Don't use a one-dimensional trading system where you just look, for example, maybe for a divergence, and then as soon as a divergence occurs, you get into a trade. Usually traders find out the hard way that this is not enough. And once you really approach strategies with this multi-layered approach, that's often where you can see an improvement in your trade quality and then hopefully also in your performance.